All right, Scott Lanigan here, and I know we're a little late, but let's recap the second quarter of 2024, starting with major stock market index performance. The S&P 500 continued to climb in Q2, albeit at a less ferocious pace than Q1, hitting multiple all-time highs and closing just 0.48% shy of another one at the end of the quarter. Surprise, surprise, the biggest reason for this positive performance is because of the ongoing excitement around artificial intelligence. This is evidenced by the tech-heavy NASDAQ composite, which was the strongest performing index both for the quarter and year to date. Meanwhile, the Dow Jones Composite Average fell and was the worst performing U.S. large cap index both in Q2 and year to date. The Dow has a heavier weighting towards old economy stocks compared to the S&P 500 and the techie growth heavy NASDAQ Composite. The Russell 2000, the primary small cap index, fell 3.28% in the second quarter and was the worst major U.S. index. Small cap stocks, being more sensitive to the domestic economy, were likely impacted by concerns over slowing growth and persistently high interest rates, which we'll discuss further in the U.S. economy segment of this commentary. Looking abroad, emerging markets performed relatively well, outperforming the S&P but falling shy of the NASDAQ in Q2. Since the underlying index contains a basket of different country exposures, there isn't a broad macro reason for why emerging markets performed well, as each country must be analyzed on a case-by-case basis. But generally speaking in Q2, the divergence between winners and losers seemed to stem from country exposure to the tech sector and commodities, along with a few country-specific political developments. To round it out, the International Developed Market MSCI FE index slightly declined for the quarter, but is the fourth best performing index year to date. Since the same country-by-country logic applies, we'll delve deeper into the countries making up these international benchmarks in our international market recap. But before we travel abroad, let's stay home and discuss U.S. sector performance. As alluded to in the previous section, the tech sector led the quarter's performance. When we dig into the individual industry contribution to S&P 500 returns, the semiconductor and semiconductor equipment and technology, hardware, storage, and peripherals industries were the top contributors for positive performance. The semiconductor industry, driven by companies selling GPUs like NVIDIA and other essential chips, and the technology hardware sector, think Apple, benefit significantly from AI advancements and overall positive tech sector sentiment. Communication services was the second strongest performing sector, appreciating 5.18%. This was pretty much due to AI as well. Alphabet, developing their own AI applications, was the largest contributor to sector performance, with both share classes averaging a 20.7% return in Q2. Netflix also contributed to performance as well, returning 11.15%, as did Fox, returning 11.95%. Finally, utilities was the third strongest performing sector, returning 4.62%. And the reason, you guessed it, AI. And I'm only sort of kidding. The electric utilities industry led this performance. Now I know what you're thinking. How can the same company that cools my house during these hot summers have anything to do with AI? Well, there's an enormous amount of energy needed to run AI infrastructure. So it would not be surprising that electrical companies would benefit from the AI industry rise. But it's difficult to tease out how much of their revenue is attributable to AI directly. After all, hotter summers increasing electricity usage likely contributed to the sector's strong performance as well. Conversely, the materials sector performed the worst, declining 4.1%. Materials companies are typically lower on the supply chain and are more dependent on business-to-business sales. Therefore, it's essential to examine the businesses that materials companies sell their products to in order to understand the demand for their goods and services. To illustrate, the largest contributor weighing down sector performance was Albemarle Corp, easy for me to say, which is one of the world's largest lithium producers. What's a hot industry reliant on batteries? Electronic vehicles and renewable energy. Therefore, any reduced expectation for demand growth will flow down to a reduced demand expectation for batteries, ergo lithium. Speaking to Albemarle, in particular in their Q1 earnings call, the slowing of EV transition in Europe and the United States decreased the demand for lithium, more so than what was previously priced into their stock price. Now that we have a sense of sector performance, let's drill deeper into some of the underlying stocks in the S&P 500, starting with one of the hottest stocks and a poster child for the AI revolution, NVIDIA. Even if you passively pay attention to markets, you'll likely know that NVIDIA continued to rip, appreciating 36.74% in Q2. As mentioned in our Q1 commentary, NVIDIA has been the poster child for AI, as their graphic processing unit, GPU, chips are widely used in AI applications, particularly for deep learning and machine learning tasks such as training neural networks and large language models. Now, NVIDIA isn't an outright AI play per se, but rather sells the GPU commodity to other businesses that develop and/or sell AI applications. However, when a company is highly profitable and has a key supplier, that supplier has significant leverage to raise prices. This appears to be the case with NVIDIA and Taiwan Semiconductor Manufacturing Company, NVIDIA's main supplier. TSM began raising prices of their wafer chips, which is logical and justified given their competitive position in the AI market. This price increase should, in theory, cut into NVIDIA's margins, although NVIDIA will likely be able to pass this cost down to their customers. First Solar stock boomed in Q2 due to AI. Yep, First Solar designs and manufactures solar panels, modules, and systems for use in utility-scale development projects. Many large tech companies have pledged to match the non-renewable energy consumption with renewable energy sources. And since AI applications consume a significant amount of energy, this pledge should create a boom for First Solar's solar panels. It's somewhat odd that this dynamic is only now being reflected in First Solar's stock price, given that AI has been a hot topic for over a year. So stock pickers, it appears there's still hope for you yet. Start coming up with your own AI narratives. I think everyone is familiar with Walgreens, but in case you're not, Walgreens is one of the largest retail pharmacy chains in the United States. If you don't know Walgreens, you certainly know their direct competitor, CVS. Much of Walgreens' recent woes stem from declining reimbursement rates that pharmacy benefit managers pay them for prescription drugs. So basically, without getting into the nitty-gritty of our healthcare industry, Walgreens is receiving less money for each prescription they fill. As a result, Walgreens missed on their Q1 earnings, and to compound this negative news during their Q1 earnings call, they also provided negative guidance and announced plans to close many of their underperforming locations. All of this led to Walgreens stock being cut in half in Q2, bringing its drawdown from all-time highs to 82.73%. Yikes. So now that we've discussed domestic stocks, let's look at international markets. Looking abroad, our friend from across the pond was the strongest performing country in Q2, returning 3.96%. Looking macro, Prime Minister Rishi Sunak called for a snap election on May 22nd to be held on July 4th. A snap election is essentially an immediate election, instead of waiting for the regular election time interval, for example, every 4 years in the United States. However, this election call had no noticeable impact on the MSCI United Kingdom's index performance, suggesting that micro and company-specific news drove strong Q2 performance. Looking at individual company performance, the primary contributor to UK stock market performance came from AstraZeneca, a British pharmaceutical company. The CEO recently appeared on Jim Cramer's Mad Money show to discuss positive developments in cancer treatment, which could potentially lead to a cure. If these developments come to fruition, it would be highly beneficial for the company's earnings and society as a whole. AstraZeneca alone contributed approximately 30% to the UK's 3.96% return, and other major contributors to positive performance included Shell and HSBC. The lovely French, unfortunately, had the worst performing developed international country, declining 6.65%. Poor performance from luxury goods retailers Moet Hennessy, Louis Vuitton, and Hermes were major contributing factors, with declines of 14.17% and 10.31% respectively. But notably, neither company's stock moved significantly on their earnings dates. Instead, their stocks declined steadily throughout the quarter, indicating a possible macroeconomic reason for the decline. The most likely macro explanation is President Emmanuel Macron's decision to call for snap elections on June 9th, creating significant uncertainty around France's legislative and economic policies. Given the notable market shift after the snap elections were called, it's reasonable to attribute the decline in MSCI France's index to this political development. South Africa was the strongest performing emerging market, with Taiwan closely behind. Both countries were largely driven by their largest holdings, which are, unsurprising given everything we've discussed thus far, in the technology sector. South Africa's Naspers, which makes up 17.77% of the index, rose 18.66%, while Taiwan Semiconductor Manufacturing Co., making up approximately 24% of their index, rose 28%. As for macro events, South Africa re-elected Cyril Ramaphosa as its president on June 14th, after which the MSCI South Africa index rallied a cumulative 5% to end Q2. No notable macro events occurred in Taiwan. Mexico was the worst performing emerging market country, with its market dropping an eye-popping 17.64%, along with the peso suffering its worst performance since the pandemic. This was largely due to leftists capturing a supermajority in Mexico's Congress and fears over enacting legislation that could undermine existing checks and balances on the Mexican government. According to a New York Times article, the proposals were first introduced by Andres Manuel Lopez Obrador and include plans to eliminate independent regulators and to appoint judges and elected officials via popular vote, which critics warn could make them more susceptible to political pressure. Among other concerns, investors feared that upending the judiciary could make it less certain that they'll get a fair hearing in disputes. These actions would ultimately increase corruption risks in a country already dealing with significant corruption concerns stemming from drug cartels. All right, now let's discuss fixed income markets. The Federal Reserve held rates steady at the current 5.25 to 5.5% range in Q2. However, rates continued to rise across the yield curve during the quarter, with the 3-month Treasury rate rising 2 basis points to 5.48%, the 2-year Treasury rate raising 12 basis points to 4.71%, and the 10-year rate rising 16 basis points to 4.36%. Focusing on the 10-year Treasury's 16 basis point increase, this rise was largely attributed to an approximate 25 basis point increase in the Treasury Inflation Index securities rate. This suggests that fixed income markets adjusted their forecast for the timing and frequency of Federal Reserve rate cuts. The differential between the 25 basis point increase in real rates and 16 basis point increase in Treasury rates implies that inflation expectations for the future are lower than previously embedded in the Treasury yields at the beginning of the quarter. Credit spreads were uneven in Q2, with investment-grade bond yields, think BBB or better, increasing across the board, subpar credit BB and B spreads decreasing, and speculative junk bonds increasing significantly. This uneven behavior makes it difficult to pinpoint a primary reason for the movement in credit spreads. However, we can reasonably assume that the belief in higher interest rates for longer significantly impacted the speculative sector of junk bonds given their relatively high debt burdens and interest costs. So putting it all together, it generally paid to be in cash and high-yield bonds. Although this may seem confusing given the previous discussion, remember that the SPDR Portfolio High-Yield Bond ETF has a high distribution yield. The income yield received was enough to offset the decline in the ETF's price due to increasing interest rates and credit spreads. Notably, high yield continues to be the best performing segment in the fixed income market year to date. Long duration securities perform the worst, with the longest duration securities like the Vanguard Extended Duration ETF dropping 3.17% in Q2. This ETF continues to be the worst performing fixed income security for the year, but will benefit from any decrease in interest rates, particularly at the long end of the curve going forward. Now, both fixed income and stock markets are heavily dependent on economic activity, so let's get to that next. The United States grew by 0.35% in Q1 2024, down from 0.84% in Q4 2023. These rates annualized to 1.4 and 3.36% respectively. While markets largely shrug this off, slowing growth is a troubling development that market participants should monitor. This slowdown was primarily driven by a modest 1.47% annualized real PCE figure, down from 2.16% year over year. As a reminder, personal consumption accounts for approximately 2/3 of US GDP. When we look at the other GDP drivers, we see that all metrics are trending in a concerning direction as well, especially net exports. Net exports track the amount we import versus what we export. So since this number is negative, it means we're importing more than we export, which creates a drag on GDP growth. Adding to economic concerns, unemployment rates rose across the board. The most reported unemployment rate is now 4%, up from 3.7% a year ago, representing an 8.11% increase. However, the economy is also adding jobs, but not enough to offset the rise in unemployment. This is consistent with the increase in claims for unemployment insurance. If you do have a job, you may be receiving a pay bump, both nominally and after adjusting for inflation. But this depends on your job and how much you're making. I say this because the ADP median pay numbers indicate that this increase in pay isn't felt evenly across the labor market. It's those who are already highly compensated who are receiving the most significant raises, and not those who are at the bottom 50% of the pay scale. Fortunately, prices are falling across the board, getting closer to the Fed's stated 2% goal. However, given this increase in unemployment and slowing GDP growth, the Federal Reserve is nearing the point of having to balance tolerating higher inflation against constricting growth and causing pain in labor markets. When we look at the residential real estate market, we can see that more inventory is coming online, but homes aren't selling. This is likely due to a mismatch between buyer affordability and sellers' unwillingness to lower prices. If mortgage rates decrease, this should theoretically make housing more affordable. However, this is highly dependent on the economic outlook when rates start falling. If rates fall because we have a healthy economy and low inflation, the outlook looks positive. If rates fall because we're in a recession with investors rushing into treasuries and the Fed cutting rates, it's very problematic. In the latter case, mortgage would default, flooding housing supply, and now unemployed first-time home buyers won't have the income to support a mortgage payment, decreasing home buyer demand. This would drive residential real estate prices downward, making properties attractive only to those with cash reserves and a stable source of income. Worse, this scenario could provide major investment firms an opportunity to buy single-family homes and then rent them out, further shutting out first-time home buyers from achieving the American dream and exacerbating wealth inequality. So we'll have to see. The economy is very fragile, and the real estate market is definitely off kilter at the moment. The Fed has its work cut out trying to achieve a soft landing. So are persistently high interest rates beginning to take their toll? Despite inflation decreasing, a majority of this drop came from the May release, which indicated essentially a zero price increase for goods and services. The previous 2 months still shown signs of significant inflationary pressures. Pair this with rising unemployment and subpar GDP growth, I think it's fair to say high interest rates are beginning to impact the economy. After all, the personal savings rate declined 20.83% from a year ago, and credit card and auto loan delinquencies are raising at a troubling pace. This implies that Americans are drawing down on their savings and turning to debt to make ends meet, which they're beginning to default on. Given this, it's no wonder why consumer sentiment is falling off a cliff. So the Federal Reserve's next interest rate meeting is at the end of July, with the following meeting in September. It's currently expected that they will keep rates steady in July, with a decent chance of a rate cut occurring in September. As always, the expected September rate cut will heavily depend on inflation and labor market readings leading up to the meeting. While CPI and PCE readings seem closer to the Fed's stated 2% goal, the Fed has stated that they want persistent signs of inflation trending forward and staying around 2%, so we shouldn't make too much into 1 month's reading. Additionally, core inflation numbers, while declining, have not decreased as much as overall inflation rates, implying that there may be some way to go before rates start getting cut. That being said, while rate cuts didn't make sense in the past given high inflation readings and a strong labor market, the higher probability of rate cuts now makes much more sense given the dynamics we just discussed. Q2 2024 earnings, all about AI. The S&P 500 is trading at a richly valued 29 price to earnings multiple compared to the historic average of 20. As an aside, this is up from the 27 PE multiple reported in our Q1 commentary. As is always the case, the higher the valuation, the more stocks must deliver on earnings to justify their price. Currently, earnings are expected to accelerate by 1.11% in Q2, but this seems questionable given the economic backdrop we just discussed and the preliminary report of a 0.57% decline in Q1 S&P 500 index earnings. So we'll see. After all, technology companies are behemoths with plenty of cash to invest, so their fates aren't as closely tied to macroeconomic developments than, say, a small cap construction company. But as mentioned during our Q1 commentary, and even more so now, future stock performance will be very sensitive to any Q2 earnings disappointments. After all, the AI hype-driven technology and communication sectors are driving much of the stock market performance, with the tech sector alone contributing over 50% to the S&P 500's returns, and Nvidia alone contributing over 25%. Any troubling developments in these sectors in particular should change the S&P 500's trajectory. Speaking to Nvidia specifically, it appears that the market is realizing it may have gotten ahead of itself, as the stock is currently down 8.88% from its all-time high achieved on June 18th. Insiders seem to be aware of this as well, with significant insider selling of a little more than 3 million shares in the last 3 months, mostly in June. For context, this is approximately 2/3 of the past 12 months insider selling. To wrap up, AI is the hottest topic right now, with anything directly or indirectly related to it causing rapid gains in stock prices. While this may make sense given the demand for AI and its wide-ranging applications, it's reaching a point where even tangentially AI-related stocks like First Solar are appreciating based on the expectation that they will benefit from the AI boom. While the narrative around First Solar makes sense, the rise in price implies that this thesis will come to fruition, which introduces risks. Whenever stocks rise above their current fundamentals, reversion to the mean is in play. So if stocks start to appreciate significantly due to AI growth expectations based on questionable theses, the stock market will begin to resemble an earnings bubble. If these narrative-driven stock pops cause herding behavior, particularly among retail investors, this could lead to a full-blown price bubble. All of this to say is that while I don't believe we are in a bubble currently and believe markets typically learn from past mistakes, like the dot-com bubble, it certainly is starting to feel a little frothy. So that's all I have for Q2 2024 commentary. I wish you all the best, and I will see you later. See ya.